Since its peak in February, the S&P 500, which represents the USA's 500 largest companies, has dropped 11%. At its worst, it was down 19%. So in this video, we're going to explore some data to discover the clear signs a stock is undervalued. If we look at all the market drops since 2002, we can see we're currently living through the 6th largest decline in that period, which is great, because it's made a lot of stocks very cheap. This chart for the last 12 months can help us understand the scale of opportunity. It shows the number of stocks listed on the S&P 500 which experienced a decline of 20% or more within a 30-day period. What's extremely clear is the impact the tariff announcements have had on the market, with 212 stocks experiencing 20% declines or more at some point in April. That's 42% of the stocks on the S&P 500. But what's most interesting about this chart is actually not this April time period, but instead it's all the time periods before, especially these months in 2024. This was a time of stock market record highs, but even then, every single month saw individual stocks drop by at least 20%. Back in August, 8% of stocks experienced a 20% drop at least, which is interesting because it tells us that even in stock market highs, value opportunities still present themselves. Look at this chart of the S&P 500 over the last 12 months. I purchased Uber stock in this period here, January 2025. Since then, the S&P has pretty much constantly declined. It looks like January was a very bad time to buy stocks. But if we overlay Uber's share price during that same period, we can see it defies the market, and it's currently up around 20% since January. So even though the market was highly valued, Uber was undervalued. So the skill of identifying undervalued stocks is not just useful for market downturns, it can be used to identify great investing opportunities all the time. Right now, there are a hell of a lot of opportunities. It's just that with opportunity, there always comes an element of risk. When a stock share price drops, that doesn't necessarily mean that there's a value opportunity there. It could just simply be dropping because the business is not as good of a business anymore. This is what's known as a value trap, and investing in value traps can lose you a lot of money. So we need to make sure we avoid those bad businesses and instead focus on finding good businesses trading at a low price. To do that, we can look at this analysis of historical data. For each of these financial metrics on the left, this analysis took the top 20% performing stocks from the S&P 500 in 2019. So for example, the top 20% of stocks with the highest profit margin, or the top 20% of stocks with the lowest debt to equity. It then tracked the average share price growth of those subsets over the next 5 years. This analysis helps highlight what's most important to a business, and it ultimately shows us the main factors that drive long-term share price growth. And there are two things which really stand out. First of all, companies which had experienced long-term growth in the past tend to continue to outperform, with the top 20% of stocks for revenue growth, equity growth, and net income growth going on to experience over 200% returns on average for the following 5 years. And secondly, the stocks with low debt levels also go on to experience strong share price growth on average. In fact, if we order this table by share price growth, the top 3 metrics are all growth related, and the following 3 metrics are all debt related. In addition to that, if we also include the bottom 20% of stocks for each of these categories, and we order the table by the lowest share price growth, we see the exact same trends in reverse. Low growth companies and high debt companies both tended to experience lower share price growth, which is extremely interesting because that analysis very clearly tells us 2 key things. Good businesses can be identified by high growth and low debt, and bad businesses can be identified by low growth and high debt. Now, there will always be exceptions to the rule, but broadly speaking, history tells us those 2 statements are true. So if you're looking to find good businesses with low valuations, then it makes sense to first find businesses with high growth and low debt, then assess the valuation of those businesses. We'll look at how to do the valuation piece next, But I'd say a simple way of identifying good businesses is to look for stocks which have a 5-year average annual sales growth of 10% or more and a debt to equity ratio below 1. And if you're wondering how you can find these metrics, there are actually lots of free ways you can do it. One site I use is finviz.com. I have no affiliation with them. It's just a good free resource where you can filter stocks by all the metrics we're going to talk about in this video. What I'd also recommend you do is just eliminate certain industries from your pool of stocks right from the start, because there are certain industries that are just very, very hard to analyze using generalized metrics. As an example, sectors like basic materials or utilities are so heavily dependent on things like the price of oil or discovering a new mine that it's just impossible to analyze them properly unless you're an expert in that specific sector. A mining company might look undervalued, but actually their mines might be almost depleted. A few different industries have their own quirks like this, particularly ones that are focused around natural resources. So unless you are an expert in one of these, I'd recommend ignoring the following sectors entirely: basic materials, energy, utilities, and real estate. But now we can be confident that we're actually looking at some good businesses, and we can try and find the undervalued ones. Now, there are two metrics we can use to do this, which when used together provide a really powerful view of a business's valuation. To understand how, we can look at this chart displaying a 10-year period, 2015 to 2025. This is the price to earnings ratio for Meta, previously Facebook, over that decade. The price to earnings is the share price divided by the earnings per share. When it's high, it indicates the valuation is high relative to the earnings or profit the company makes. And likewise, when it's low, it indicates the valuation is low compared to earnings. Typically, for the industry Meta is in, anything below a price to earnings of 20 would be considered relatively low. We can see all the periods where the PE has been under 20 displayed in red here. But there is a big issue with just using the PE ratio. A company might have a low price to earnings, and it could look undervalued. But actually, its sales, for example, might be declining, and so the share price could continue to drop. That's one of those value traps that we talked about earlier, and the single best way of avoiding a value trap is by incorporating growth into your valuation. Let's look back at this chart for Meta, but now let's add in the price earnings to growth ratio, also known as the PEG or the PEG. This takes the price to earnings and then divides that by the expected future growth in earnings. The higher the PEG, the more overvalued the stock is. And because it incorporates growth, stocks with a low PE ratio, but who have stalling business growth, will still have a high PEG ratio. So now you can identify they're overvalued even if their PE ratio is low. Typically, anything below a PEG of 1 is undervalued. In these cases, all the company would have to do is simply meet its expected earnings, and the share price should experience a significant positive correction. And if we highlight the periods for Meta where the PE ratio was below 20 and the PEG was less than 1, we get this single period here in 2018-19. But we can also see this period in 2022 where the PEG was just a whisker above 1. And the PE ratio was tiny. At its lowest, it was just 8. So with that considered, I think it's fair to identify both this period in 2022 and this period in 2018-19 as periods of undervaluation. Now let's add in the share price for that decade. What's clear is these periods of undervaluation correlate with two of Meta's lowest share price drops. But far more importantly, both those periods of undervaluation are followed by significant share price gains. This period following 2019 represents a 200% increase, and this period following 2022 peaked at a share price rise of over 600%. And this certainly isn't unique to Meta. In fact, if we're going to talk about value stocks, then we have to talk about this guy, Warren Buffett, the most successful investor of all time. This chart shows Apple over the last 10 years. Here's its PE ratio and here's its PEG ratio over that time. Again, let's highlight only the periods where both the PE ratio is below 20 and the PEG is below 1 to find those periods of undervaluation. It shows just one instance, the early part of 2016, and here's Apple's share price since that period. It's gained around 800%. and Apple has become Warren Buffett's most successful investment of all time. And this is when Buffett started investing in Apple, during the first quarter of 2016, precisely during this period of undervaluation. Identifying good businesses with strong past revenue growth and low debt, and then using a combination of the P ratio and PG ratio to find periods of undervaluation is an extremely powerful way to find great value investments. It's how I'm still 30% up on the market with Uber in the worst 4 months the market has seen for years. To find that Uber investment, I used my own unique stock analysis database and AI. You can actually use it for free at hellostocks.ai. My background is data analytics and data engineering, so I've been building stock market analysis tools for years. I enjoy it, I'm nerdy like that. So now I can just pull out my phone and I can ask it, give me 2 good and fairly valued businesses in the tech sector. And it'll give me an up-to-date report on 2 good and fairly valued businesses in the tech sector. Like that. Like I said, it's free to use if you want. Just make sure you do your own research as well, because I'm not a financial advisor. But you'll also want to make index funds part of your portfolio as well, not just individual stocks. So to understand how you should invest in those, you can watch this video here. It looks back over the last 100 years of the stock market to see when the best times are to invest.